Stocks are plunging today. The Dow's down more than 1,700 points as some states experience an increase in coronavirus cases as they reopen from lockdown. Joining us for more on the sell-off, Jeffrey Sherman, Deputy Chief Investment Officer at DoubleLine Capital, and Dan Suzuki, Deputy Chief Investment Officer at Richard Bernstein Advisors. Good to have you both here. Jeff, how do you see the why for the magnitude of the selling? Are you pinning it on the Fed, on the cases, on just a need to pull back after an extreme run? What is it?
Yeah, I mean, it's an extreme run, I think, across all risk assets. And so if you look earlier in the week, we had the RSI, the Relative Strength Index, a technical indicator looking at the last 14 days of roughly half of the S&P 500 getting north of 70%, north of 70 read on that relative strength indicator. And what that means is that they're overbought. And so all it took was a little trepidation in the market to really get things going. And you could see how it really exacerbated as the days went on. And I think what you see here is that this is the Fed did what they could. They came out and said, look, we've given you low interest rates. We're telling you we're going to be low for a while. We don't have negative interest rates on the table right now. Maybe we do some form of yield curve control, but at this stage, what they want to do is communicate that we're going to commit to low rates for a long period of time, and that's their way of saying we're here to support the market. They're still doing $120 billion a month in quantitative easing. I put that in perspective. That's 50% higher than we did in quantitative in QE3. And so what the Fed has said themselves is that they've done all they can. But I think there's just too much optimism in the market. I was listening to the report beforehand, listening to the energy side, and you don't see the gasoline demand there. You don't see TSA traffic. There's a lot of pieces of the economy that aren't showing the V shape, but the markets had priced that in. So I think they're going to be susceptible to economic volatility as we get more data through. And as you'd mentioned, too, the virus cases accelerating in certain parts of the country is reason for concern here. And so it's something that the tone out there has been very, very bullish. It's been ignoring the economic data. And even Mr. Powell said himself, he's not looking at market performance to corroborate. He's looking at the economic data, and it just does not corroborate some of the V shape we've seen asset price recovery.
Jeff, in terms of what's priced in, clearly yields have collapsed this week from close to 1% on the 10-year to now down to 0.6 or so.
Yes.
What would you say is more likely, a rate hike again by the Fed by the end of 2022, or the Fed going negative?
Well, we've kind of dug our heels in. We hope the Fed doesn't go negative because we've seen that experiment just not work in other parts of the world. And so I think that's the old quote that's attributed to Einstein. The definition of insanity is doing the same thing over and over again and expecting better results. So I'm going to say the rate hike would be more likely. But at this stage, rate hikes are on the table. The Jay Powell told you yesterday that regardless, they're not even thinking about hiking. He's trying to just nail that into investors' heads. So I don't blame the Fed for this sell-off. I blame the virus for it and the optimism that's out there. And, you know, we see the death studies out there that talk about a second wave. This isn't a second wave. We're not through the first wave yet. And so when we look at anecdotal data, you look at the open table reservations, you look at the gasoline demand the EIA puts out, what you're finding is that we're just on the cusp of turning. Look, it looks like a lot of the worst is behind us, but it sure doesn't look like we're out of the woods yet. And I think that's what you're seeing there. So I'm going to say that still, I don't think the Fed wants to go negative. They know that it would really cause problems in the banking system here in the U.S. And given what we're the largest banking system in the world and the reserve currency, it'd be very challenging for us to weather that globally.
Jeffrey Sherman, Dan Suzuki, thank you both very much.
Thanks for having us.